In this presentation, we will work a problem related to recording transactions for a capital lease for a capital project. We're going to have the information on the left side. We're going to enter that information into the blue area on the right side. We will be journalizing the journal entries here and then posting those journal entries to our worksheet, our trial balance worksheet, which have the beginning balance, adjustments, and the ending balance. This will give us an idea of the accounts and how they will be affected. Assets will be in green, liabilities in orange. Assets minus liabilities, or what would be the equity section in a for-profit organization, light blue. Dark blue, what would be the income statement in a for-profit organization, those temporary accounts. We'll have this for the debt service fund as well and the government-wide activities. So let's go back to our data. On the left side, we have the capital lease for a capital project. We have in 4 installments that we're going to make of $483,000. Total paid is going to be the $2,898,000. The interest rate is 8%. The present value of the lease then is going to be this amount, and the fair market value is going to be this amount. The initial payment is going to be equivalent to our payments of the $483,000 on the inception of the lease. We're going to first record this into the government-wide activity because that's going to be the area that's going to be most familiar for us with these capital leases. And what we're going to say is that we have a capital project of the building. So we got the building that we have a lease on, and we had an initial payment for it. We're going to record it more similar to a purchase as opposed to an operating lease. So we're going to say that the building is actually going to go on the books, and then we're going to pay cash. We're going to pay cash for that initial payment that we paid, and the difference then is going to be the liability, kind of like if we purchased it and financed it, and that's going to be a liability which we're going to call a lease obligation payable. So there's going to be our data. The cash we're going to pay is going to be that first installment. So we know what that amount is going to be. It's going to be negative of the cash that we're paying is the $183,000. And then we're going to pick up the value of the building, which we're going to put as the present value of the payments. Is going to be this $2,850,441. So that's the next item we're going to have on the debit. So we'll put that up top in Z3. This is equal to, scrolling back over, the present value of the payments. That's in essence what was paid for it, we're saying here. And then we're going to say the negative sum is going to be the difference. Negative sum is what is still owed at this point in time. That's going to be the lease obligation. So let's post this out. Then we're going to say the building is going to be increasing. We are in cell AE4. This is equal to the debit to the building. And then we have cash underneath that. So cash is going to be in AE3 equals the cash, which is going to go down. And then we have the lease obligation. The lease obligation is in AE6 equals, and we'll pick up that credit, and there we have it. So our debits and credits were back in balance. Now we basically want to take this transaction and take it apart and think about what would be the transaction for the debt service fund, where we're thinking about the flow, the financing. We're not going to be recording then the payable here because this is going to be a long-term capital project. We're typically recording the flow activity in terms of the financing, and therefore we'll be picking up the cash amount. So if we think about the debt service fund, the related transaction in the debt service fund, we're going to have an expenditure. So we're going to call this an expenditure on the lease obligation. So this is going to be the principal of the lease obligation expenditure. And then the cash is going to be the credit. So the cash is going to be the credit for the amount of the payment. So we'll pick up the amount of the payment, which was at $430.83. I'm going to make this a positive number by flipping the sign. So there's going to be our transaction here. We could post this out. Then we're going to say, all right, now the expenditure on the debt service fund is increasing by that $483. The other side is going to be going to cash. So cash is going to be the other side. So there we have that. And then if we go back to the government-wide activity and we think about this in terms of the capital project fund, it's this part of a capital project for the building. Then we want to piece this apart and say, well, what are we going to put in the capital project fund? That's going to be related to, in essence, the value of the building. And that's going to be going into the value of the building being the expenditure, the capital lease. And the other side is going to go to not the obligation, the lease obligation, not to a payable, a long-term liability, because we're on the modified accrual basis, and we're going to record it instead as an other financing source. It's going to be the other financing source within the capital projects fund to finance the capital project. So if we scroll back over to the capital projects, then we're going to say that we have an expenditure. So we'll have the expenditure, and then we have the other financing sources, and this is going to be for the lease agreement. So we're going to say that this is going to be, I'm going to say negative, and if I take it apart from the governmental activity, we're picking up this component now, and the debit then, and there's the credit. So if we record this out, then we have the expenditures. The expenditures are going to be increasing, and then we have the other financing source. Now the other side, other financing source agreement in case 7 equals the credit, and so there we have that side. So we've took basically this transaction, the government-wide activity, and you could think about this transaction and then think about what's going to happen in terms of the debt service fund and what's going to happen in terms of the capital project fund. Next thing we're gonna record is say that there's a payment at the end of the year. So at the end of the year, we're gonna make this payment, this $483,000 payment. Let's think about what would happen there. Let's do this first in the government-wide activities and record the payment as we would expect to see it if we were to pay off a payment of the lease obligation. We know that cash would go down. I'm gonna put that on the bottom, so because that's gonna be a credit. It's gonna be a credit here. We're going to make the payment for the same amount because we're making the same amount for the capital lease. That's going to be the credit. And then on the debit side, we're going to have the expense related to interest, because we're going to say this is a capital lease. We're going to have to calculate interest. So we have the expenses for interest, and the interest rate we said was 8%. So what we're going to say is we're going to take the lease obligation. I'm going to say negative of that number, multiply it times 8%, which is it's not a point, times 0.08. So we're taking the lease principal times 0.08 because it's going to be for a year. We're making the payment at the end of the year is our assumption here. And then the difference is going to be the decrease in the principal. So now we're going to have the decrease in the principal, which is going to be this minus, let's put the decrease in the principal is going to go to lease obligation payable. And then the amount is going to be this minus this. So I'm going to do that with a plus. That'll add them. And then I want to flip the sign to make it a debit. So I'm going to put a negative and then brackets around it. So I want to take that whole thing and multiply it times -1 in essence. So there we have it. So now the debits then equal the credits, and we could record this out. So we have the expense for the interest on the lease. That's going to be in AE10 equals the debit. Then we have the obligation lease payable. So we got the lease payable, lease obligation payable. That's in AE6. I'm going to say F2 plus F2. Put the cursor back down and pick that up. And then we have the cash. So cash is going to be over in AE3. And I'm going to say F2 plus F2 and scroll back down to the credit there. So there are those. So now we can take this and say, okay, what's going to happen in terms of the debt service fund now? We could take this transaction and say the debt service fund is going to be similar, but we're going to have different accounts. So the cash is still going to be going down because we're paying off the debt service, the capital lease. The expense to the interest, we're going to have a similar interest expense there as well. However, the lease obligation payable is not going to be on the debt service fund, but instead we're going to have a flow type of activity, modified accrual. We don't have the long-term account of the payable. We're going to have that as an expenditure too, record in the flow under the modified accrual debt service accounts. So let's reconstruct this basically in the debt service fund. And we're going to say we know that cash is still going to go down. So cash is going down. Then we have the expenditures. We have the expenditures, which are going to be related to the interest, which is the same. And then we have the expenditure related to the principal. That's the thing that's different because here it's in a temporary account, more like an income statement account. The amounts are going to be the same. I'm just going to pull over the same amounts here. So we've got the this amount for the interest, and then the principal. We'll pick up the principal is going to be here. And then the cash, we can say negative sum or pick up from the problem as well. And there we have that. So let's record this out. Here we got the expenditure for the interest. So if we scroll down, we have the expenditure in U9. We're going to say this equals, scroll up to the interest. Then we have the expenditure for the principal. So here's the expenditure for the principal in U8. I'm going to say something's in it. So I'll say F2 plus F2 and pick up that one. And then we have the cash. So then we have the cash that's going to be up here in U3, F2 plus F2, and we'll pick up the cash. So there we have that item. There's no activity from the capital projects fund for that payment.